Hi, everyone. Welcome to the Pitchbook Venture Capital Update. With this session, we will run through a quick presentation of our venture capital data, and then we will also provide a demo of our platform, which I believe everyone will have access to after this event. My name is Kyle Stanford. I'm a senior analyst here at Pitchbook. I cover venture capital, with specifically looking at kind of non-traditional investors, which are all those that don't have a traditional venture capital return profile. Venture ecosystem, so I dive into different areas of the US and look at how deal flow is occurring there and what's changing. And then for our demo, Keegan and Phillip will run you through our platform and give you a good rundown of how our platform works. For those of you not familiarized with Pitchbook, we are a data and research firm located in Seattle with offices around the world. We cover public and private companies, people, investments, funds, kind of you name it, and we have it all in a nice, tidy platform and area for everyone to look at. Before I dive into any specific areas of the VC market, it's really good right now, especially with how everything is occurring and kind of the craziness that's happening in the US VC market, to look at what's kind of the overall picture. So far through just 3 quarters, it's it sounds kind of corny, but everything is basically a record. And that term record is really getting overused in our reports, in our research. But almost 13,000 VC deals have been completed in the US in 3 quarters, which is already higher than we've ever tracked in our data set. We're also looking at $239 billion invested. Now, a lot of that does come from the top end of the market, where we're seeing several billion-dollar deals and whatnot. But the overall activity in the US market is something that is really phenomenal. The market is just much different than it was a decade ago. We get a lot of questions, why is this happening now? What is different than 3 years ago when valuations were too high and there was a lot of capital in the market? Well, looking at our recent benchmark data, the venture capital asset class has been the highest performing strategy of any private investment strategy over the past 10 years. 15.2% IRR. That's higher than private equity. That's higher than real estate. And even the last 3 years, we're really seeing kind of what you would expect from really crazy venture capital return years. We're looking at 44% over 3 years and 52% over the 1-year horizon, which is really phenomenal. That's driving a lot of interest, not only from LPs, but we've seen a lot of new funds being raised. And that's driving a lot of competition in the market. With that outperformance, we're seeing a lot of the non-traditionals, hedge funds, mutual funds, private equity funds, corporate venture capital is really a big part of the market right now. Of that $239 billion that we've seen invested so far, $183.6 billion of that has come from a deal with a non-traditional investor participation. These investors have a much larger capital set to invest out of into VC. So we're seeing a lot of upward pressure on prices and valuations. And this is a quick look at kind of the exit market we've seen this year and over the past couple of years that's driving that outperformance in VC. Already over $500 billion has been returned or has been generated exit value by VC-backed companies this year. 88.2% of that has come from IPOs. We've seen 10 exits that have completed a valuation of 10 billion or larger. Overall, we've seen 23 of those in the US total, including these 10. And so we're seeing a truly remarkable year. We expect this to help generate even more interest in the VC asset class moving forward, as this capital gets recycled into back to LPs and then back into VC funds. We've also heard a lot of hedge funds, mutual funds, and other LPs that are going to increase their allocation to the venture asset class. So we expect more activity to occur, not only for the rest of the year, but likely all through 2022, and 2023 is set up to be really strong as well. All right, so going through a little bit of the deal activity in just angel and seed to start off with. While the top end of the market gets a lot of the media attention, the billion-dollar deals, the huge mega deals, the angel and seed investment area has been really strong as well. We've seen, a very strong rise in the seed activity over the past few years. And already through 3Q, we've seen a record amount of capital invested in angel and seed deals in the US. One thing that's really happening at the seed is that there's been movement by larger multi-stage investors down into the seed area. This is increasing the median deal size and seeing a lot of the top end of the seed deals close in a much larger area than we've seen in the past. Everyone has heard seed is the new A is the new B. And while the mechanics of the rounds may not have changed or shifted that much, when we look at the deal size, a median size seed deal this year is larger than a median Series A deal was in 2010. It's just a remarkable surge that we've seen in the lower end of the market. But another thing that's really happened in seed and angel over the past few years is new areas of investment opportunities coming from. We've seen the growth of rolling funds. We've seen solo capitalists. We've seen, a lot of the huge exits have created not only more capital to be invested by executives, but we've also seen, huge wealth growth from employees that have worked at these companies that now have the liquid assets available to invest or start investing and become scouts for VC firms up the pipeline. Here's a look at kind of the median deal size, and you can see really how seed has grown over the past decade. There's definitely been a bifurcation between these two, angel and seed. They've become very different investment stages. Angel investment is much more formulaic than a seed investment has become. But that doesn't decrease the benefit of the increased angel activity that we've seen in the US. As we look down the list of kind of most active ecosystems in the US, obviously the top four, Bay Area, New York, Boston, and Los Angeles have been really strong. But we've seen the top 20 ecosystems in the US as from deal count increase their activity during 2021. A lot of this is being driven by an increase in activity or in interest in the VC market, not only from those large funds that I've talked about, but also from the angels and seed firms that are emerging within the market over the past few years. Along with deal sizes, valuations have really increased. At angel and seed, a $9 million seed valuation a few years ago was probably unthinkable. But that is where we're at today. I will say that a lot of these trends are driven by those four major tech ecosystems that I mentioned in the past or mentioned before. Bay Area, Boston, New York, and LA drive more than half of US VC activity across all stages, which is driving those trends. So the $9 million median pre-money valuation for seed is definitely going to be trend higher in those areas than it is across the market. But overall, we're seeing a very steep jump in 2021 and especially over the past few years. The early stage, which we count as Series A and Series B deals, has also seen a huge growth. There's going to be somewhat of a constraint on the amount of growth that can be here because we count only those two deals or those two deal series. But $54.7 billion has been invested in early stage companies this year alone. We had never before 2021 seen a quarter with more than $15 billion in early stage investment, and each quarter this year has surpassed that. Like we said, like angel and seed, we're seeing larger investors move up the venture life cycle, and the way that companies are able to, the speed with which companies are able to grow now is driving larger deal sizes and larger valuations. We expect a lot of these companies to continue to move through the venture life cycle. From a down round perspective, which is what we've looked at in the past, or what we would expect to rise as deal sizes and deal valuations have increased, is hovering somewhere around 7% in 2021, which is the lowest we've ever tracked. There currently seems to be no real reason to fear other than potential or theoretical threats down in the future here. But we're looking at a really strong early stage market. for founders and strong companies out there. We look at those deal sizes. We keep mentioning the growth in them, but you can really see here how the spread in between the bottom quartile and top quartile companies or deal sizes is really growing much larger. Those large investors coming down the pipeline are going to definitely bring with them a larger capital base. When you look at SoftBanks of the world or Tiger Globals of the world making investments in early stage, they're not going to come in and kind of look at the median deal size. They're looking for those high growth, really strong companies, and that's really pulling up that top end of these deal sizes at the early stage. One thing that I want to point out here is that when we look at VC-backed M&A, companies that are VC-backed that are getting acquired, 85% of those companies are getting acquired before they reach late stage, which would be Series C or later. This is one important aspect that we want to keep an eye on when we look at these larger deal sizes and growing valuations at the early stage. Not only do the growth in those areas come with higher expectations of growth for the company, but they do come with a higher threshold of what a successful exit may be. Again, with the low down round percentage, we don't see any current threat as far as investor pullback or acquire pullback from this area. But again, in the future, this could be something that we come back to and look at as one area that has got too inflated, but to be seen. When I talk about the top end of the market, we've been looking at mega deals, which are deals of 100 million or larger that have occurred. Overall, there have been almost 600 completed this year alone, which is, again, unfathomable only a few years ago. But that has also trickled down to early stage companies. More than 100 early stage companies have raised a deal of 100 million or larger, which is very remarkable and something we will continue to see moving forward. A lot of these deals, 78%, actually have one of those non-traditional investor participants within it. Again, SoftBank, Tiger Global are kind of two of the ones that pop up the most, but Fidelity, T. Rowe Price have really been active. Coatue has an early stage fund that is very large. And these investors are coming down the pipeline because they're missing out on a lot of the growth in VC as if they wait until companies go public. When we look at the proportion of tech companies, especially that IPO before $1 billion valuation, it's very low these days compared to what it used to be. And that's where these non-traditional and crossover investors are coming in and making sure that they're able to, find the growth that these VC-backed companies are attaining in the private markets. So as we, look at the future and kind of what is happening, we talked about those non-traditional investors that are going to continue to be within the market, continue to invest. But fundraising activity for U.S. venture firms has been astronomical this year. Already $96 billion has been raised by U.S.-based VC funds. Again, more than we've ever seen in our data set. But there's a lot of great information within there that is not highlighted in this chart. 240 micro funds have been raised already this year. One thing, while that's not yet a record, we do expect it to eventually surpass the last record. We do see a very large lag in the closings of these funds. A lot of them are emerging managers and may not close on a very timely schedule. So we will see a backfill of these micro funds. So when we look back, this 3-quarter data may be up towards of 300 funds that have closed already. This is going to bring more and more capital to the angel and seed and early stage financing areas. We have looked at in the past and said that there is a decline in these funds and what is happening to the angel and seed stage or pre-seed stage. And this is really a focal point of what we're looking at now is how strong the future is for companies that are trying to break into VC or entrepreneurs that are looking for capital. There's going to be so many funds out there in the market now or in the market next year looking to invest in that first check or second check. The VC is going to have a really strong pipeline of companies moving forward over the next couple of years. We also talked about, larger funds being raised. Greylock Partners raised or added $500 million to their fund to invest specifically in seed companies. Andreessen Horowitz launched a $400 million fund to invest specifically in seed companies, and just kind of, while those definitely aren't micro funds, it's just more and more capital and kind of a window into what the seed stage has turned into over the past few years. This chart is looking at the dry powder that's available in the US. And as you can see, $221.7 billion is more than we've ever seen ready to be deployed by US-based venture funds. This is also something that when we looked at, why wasn't there a huge pullback in the venture market during COVID? A lot of it is because the amount of dry powder that was ready, that was still there, ready to be available or available to be invested, was already really high. While there, could have been, LPs could have defaulted or decided not to make their commitments. The downturn was short enough that there was no hiccup really in the venture market. The only hiccup came when investors and entrepreneurs had to kind of shift everything to Zoom and figure out the new market dynamics. With the amount of capital there ready to be deployed, the venture industry really got back to their pre-Q2 2020 levels, and are coming in with the levels we're seeing today. We've also mentioned multiple times those non-traditional investors. We've estimated that globally there's $250 to $350 billion available from those non-traditional investors to be invested in the venture capital market. As they increase their activity and their direct activity in venture, this amount of capital is why we're seeing those top end deals and top end of the market really spike. Again, this is something that we will continue to see. So let's see, I have a question here. The changing landscape of LPs. I think, as you can see here, LP interest and allocation to venture has been really strong. It's bringing the returns that are occurring in VC are bringing more and more LPs to venture funds. I think when we talk about the emergence of rolling funds as well, kind of those smaller end funds are bringing new access to new LPs to come into the market and invest in these venture funds, which is a really exciting area of opportunity for not only those LPs, but also for fund managers looking to raise, their own fund to go out and invest. And yeah, I think the group of LPs is still changing. We've from multiple areas of LP interest, allocations are increasing, whether it be from hedge funds because their investors want a piece of these private companies or these unicorns, or whether it be from large institutions. We've seen Yale and Brown, I think it was, see really huge returns from their funds, and that's only going to drive more interest from other endowments and other types of LPs. So we're at a really exciting time for venture fundraising, and we expect this dry powder figure to continue to rise over the next few years, and those non-traditional investors continue to bring their capital to the market. So with that, I'll pass it over to my colleague Keegan, who can run you through a demo of the platform.
Awesome. Thank you so much, Kyle. I hope everybody can hear me. I know that was a ton of information, but I hope everybody was able to actually absorb all that data. As Kyle mentioned earlier, my name is Keegan Phillip, and I am Senior Manager at Pitchbook. Part of my role is working directly with customers. I work as part of the customer success team at Pitchbook. Now, for this segment of the second segment of our presentation, it's going to be a little bit different than the last one. It's going to be less of a presentation and a little bit more of a conversation. So I want you guys to be asking questions in the chat box. I want you guys to be freely communicating with me. I know you guys can see me, but I can't see you. So one of the things that I do want you guys to do is this, if you see or hear anything that you like that I'm saying, I want you guys to write the word deal in the chat box so I know that I'm on the right direction, I'm going in the right path, and I can keep going. So why don't we do that right now? For anybody that's on the call, just type in the word deal in the chat box. and then we're going to kick things off. And then just like a quick question, one of the things that I always tell founders and other like entrepreneurs, one of the things that I actually hate is just hate being discounted. I saw a question actually pop up in the comment box of, like, are LPs diversifying their investment into Black fund managers, right? So I was actually on LinkedIn not too long ago, and I was but I was just browsing through my news feed, and I came across a post by a managing director at Harlem Capital Partners, and he was venting about that exact issue. Like this tendency for diversity in investing in Black fund managers and Black investors to just kind of be bucketed into this impact investing bucket. And not that impact investing is a bad thing, but it's a tendency to just minimize the issue and that support for Black entrepreneurship, Black investment as this somewhat so-called advocacy issue. So last year, actually, when I spoke and was getting ready to speak at Black Men Talk Tech at the conference last year, one of the things that I learned was just the fact that despite only being 12% of the population in this country, we make up for about 20% of the new business growth in this country. And that's more than any other ethnic group in the United States. So if that doesn't tell you that equity for Black businesses and Black investors isn't an advocacy issue, but an American business issue, I don't really know what does. I've always said that one of the things that we've been promised in this country is equal opportunity, but we've been denied is equal access. And that's access to information, access to certain resources, kind of getting left out of the room. But with that said, we have an opportunity here to leverage PitchBook, and you guys will have access to the platform today. So I'm going to start sharing my screen. You guys let me know when you can see it. Just type in the word deal in the chat box, and we will go ahead. And what I'm going to show you guys today is how to access some of those advocates that will put a rubber stamp on your business, those investors, those fund managers, and we can take a look at how to actually source that information within PitchBook. If we had time, I would love to show you how to find customers as well, because let's face it, if you don't have sales, you don't have a business, you have a hobby. So customers also put that rubber stamp on your business as well. Can you guys see my screen? Awesome. Okay, so first things first, what we're going to do is we're going to head over to the PitchBook platform. This is the first thing that you're actually going to see. This is the dashboard. So in order to run an investor search, you're going to come over to this section here that says screeners. And we're going to go down to the third section here, and we're going to click on the investors and funds category. Now, within this investors and funds category, you're going to get a ton of different options, right? This key field section is going to give you guys pretty much everything that you need in order to run this screen. But I'm going to build out a really quick screen for venture capital by heading over to investor types first. I'm going to select venture capital here. And then I'm going to select primary investor only. Now, when you guys actually have the platform, have access after this conference, I want you guys to make sure that you're following these exact steps. If you ever need help, there's this help center in the top right-hand corner of your screen as well that has like little video tutorials that you can follow along with and refer to. In investor location, we are going to look at just the United States, and we're going to look at investors that are headquartered in the US. So PitchBook tracks deal activity and deal flow all over the world globally. So it's not just the United States. We're going to be looking at other US regions. We can get as granular and go into Florida if you want. But for now, we're just going to look at the entire United States. Next up, we're going to go to deal criteria. And we're going to say, let's show me the deals that happened this year in 2021 and mark them as completed. And then lastly, actually, second to last part, we're going to look at the deal type. We're going to focus in on venture capital, and we're going to look at early stage VC. But we can also see that we're tracking activity in corporate M&A, private equity, IPO and liquidity events. We can even see asset acquisitions, corporate divestitures, all that good stuff. Even distress, private debt as well. Now, the last thing that we really need to identify, and this is going to be really relevant to each one of you. You guys each operate in separate industries, in different industries. So you really want to define where those investors are actually investing capital in. Every company, over 3 million companies that we're tracking in PitchBook, we're going to be quickly approaching 4 million. Pretty much falls within one of these 7 major industry buckets. And then you can drill down a little bit further by clicking this plus sign and go a little bit deeper and see, okay, let's look at software and just like kind of carve it up a little bit more and even dive a little bit deeper into, let's say, business productivity software. We're going to just use that. Kyle mentioned earlier Zoom, and just because of the pandemic, the global pandemic, we know that a lot of businesses try to optimize their workflows last year just because of the pandemic with people working from home. So business productivity software definitely saw a lot of activity. In addition to these industries, we also track verticals, and verticals are essentially going to be categories that don't necessarily fit cleanly into one specific industry, but could be applicable to many others. So things like artificial intelligence and machine learning. I think in one of the pitch competitions, I saw an autonomous car company that really piqued my interest. You can see cannabis, blockchain, Bitcoin, all that good stuff. But we're going to keep it simple because I know we're pressed for time. We're going to run this search. As a recap, we're going to be looking at deal activity for this year to date, 2021, business productivity software in venture, early stage in the United States. So our next step, we're going to click search. Now, as PitchBook loads, we're going to be getting a list of about 1,088 investors, right? That's a lot of investors that are conducting activity in a given year. And for you as a user, a business owner that are looking for investors, what's your next step is actually going to be is to identify and prioritize who are the investors that you would essentially want to reach out to. So the way the PitchBook is currently built out is going to resemble an Excel spreadsheet, right? So this should be somewhat familiar to you guys if you guys are familiar with Excel. One of the ways to prioritize your view is to pretty much just organize and sort the information by the number of investments. So here we can see in 2021, the investors that are conducting the most investments in business productivity software are going to be GGV, Tiger Global, SL, Andreessen Horowitz, just to name a few. And you can see them ranked this way. To further prioritize to see if they are actively making investments, we can go, I might have did that a little bit too fast. We're going to go to this edit table section here. Then we're going to click on it, edit columns. And the next thing that we're going to check off is we're going to look at investments in the last 6 months. That's going to give you a ton of insights into what that activity has been in most recent months, right? So here we can see Tiger Global actually did all 28 investments in this space in the last 6 months. If you want further information about this firm, all you have to do is click on their name in PitchBook, and it'll take you to their profile page where you can then see some general information about the Tiger Global team and what they do. You can head over to their team and see who are the individuals, the partners, managing directors, the investors, who are those people that actually write the checks that you would need to reach out to. You could take a look at the deals that they've participated in and the companies that they've invested in. And most importantly, if you're ready to connect with those individuals, you can get their email addresses. So valuable information for you guys. You can definitely leverage that information as well in order for you to actually make these connections and find that advocate for you to improve your business. I'm just going to head back over to this last screen right here and just show you one little section as well that I think that would be very valuable to each one of you. On this investor screen, there is a lot of other options. Like you'll be able to see people. You can see the limited partners that are committing capital to these investors. You can take a look at their funds. You can look at the companies themselves that they're making investments in. You can also organize the data within a pivot table. And then this charts feature is actually really awesome. If you go in this charts feature and you bring it up, you can switch over to, say, a pie chart, and you can see where these companies land as far as primary industry sector. But if you recall, I mentioned the verticals before. If we change the breakdown by verticals, you can now prioritize and see, like, hey, who's actually getting funded and what types of companies are getting funded? What's the biggest pieces of the pie, so to speak? So you can see SaaS companies making up most of that investment so far in early stage in business productivity software during this year. So over 18%, followed by machine learning, then big data, then TMT, then fintech, and so on and so forth. All of this information is dynamic in PitchBook. So if you hover over it, you'll get like a quick little synopsis, but you can always click into that pie and get additional information about the actual companies, a description about the companies. Are they generating revenue? What's their valuation? And what's the deal size that they actually received and what the deal date is as well. This will be helpful as well if you guys are running some sort of comps analysis and you want to compare yourself against your peer group. With that pretty much just wraps up my segment. I know we're very pressed for time. I wish we could do a little bit more, but I know you guys have a really packed day of other presentations. So if you have any other questions, please let me know. Feel free to not Slack me, but send me an email on LinkedIn, and I'm happy to answer any questions that you guys might have. And that's all I have for you. So take care and goodbye.
Yeah, thanks everyone.
Thank you.